Hello, and welcome to this short Global Accounting Consulting Services webcast looking at IFRS 15, the new revenue recognition standard issued by the IASB and the FASB. I'm Tony DeBell, a partner in Global ACS, and I'll spend the next few minutes giving you a high-level overview of the new standard and the key changes. IFRS 15, Revenue from Contracts with Customers, is the culmination of a long-running joint project between the IASB and the FASB to create a single revenue standard. It applies to all contracts with customers, except those that are financial instruments, leases, or insurance contracts. It is effective for annual periods beginning on or after the 1st of January 2017, but entities that use IFRS are allowed to adopt the guidance before the effective date. There is a choice of transition methods: full retrospective application or a practical expedient that permits prospective application together with additional disclosures. So what's changed? IFRS 15 will replace IAS 18 and IAS 11, which currently provide separate revenue recognition models for goods and services and for construction contracts. IFRS 15 is based on a single model that distinguishes between promises to a customer that are satisfied at a point in time and those that are satisfied over time. Revenue is recognised when control of a good or service transfers to a customer. The notion of control replaces the notion of risks and rewards in the existing guidance. One of the more significant changes is that IFRS 15 provides a lot more guidance than the existing standards. For example, it has more detail on multiple element arrangements and variable consideration, and provides specific guidance on the accounting for licenses, customer options, and repurchase arrangements. This is likely to affect existing practice, especially in complex arrangements where the existing guidance is limited. The core model and its scope have not changed significantly from the original proposals first exposed by the boards. The core principle is that revenue is recognised when goods or services are transferred to a customer. The model is based on a 5-step approach. Management first identifies its contracts with customers and identifies performance obligations, the distinct goods or services that have been promised to those customers. Management then estimates the consideration it expects to be entitled to, known as the transaction price, and allocates that transaction price to each performance obligation. Revenue is recognised when a performance obligation is satisfied by transferring a distinct good or service to a customer. The core model remains unchanged, but the final standard reflects input from constituents and from the board's own redeliberations on a number of controversial topics, including collectability, variable consideration, and the accounting for licenses. Applying the new standard will require judgment, particularly in complex arrangements. Some of the more significant judgments will arise in identifying distinct promises or performance obligations, accounting for arrangements where the transaction price is variable, accounting for licenses, and determining whether a promise is satisfied at a point in time or over time. We will talk more about these topics over the next few weeks. An area of potentially significant change is disclosures. The requirements have increased significantly from the previous standard. These are just some of the highlights from IFRS 15. More information, including webcasts and industry-specific guidance, will be available over the coming weeks and will be designed to help people start thinking about implementing the new standard. Keep up to date by following the news on PwC Inform.